Hi everyone, Luke Stein here, and this short video is going to cover some basic issues about key financial statements. So most firms are required to file 4 basic financial statements. That's the balance sheet, which talks about the things that the firm owns, the financing that the firm has received, and the debts that the firm owes. The income statement, which covers revenue, things that the firm sells, expenses, those are the costs of producing, distributing, etc., the things that the firm sells and running the business, and the difference between revenue and cost, which is called profit or net income. The cash flow statement, which covers cash that comes into the firm or sources of cash, and cash that flows out of the firm, sometimes called uses of cash. And then finally, the statement of shareholders' equity, which covers the level and changes in the ownership stake that the firm's shareholders or equity holders have. So as we think about these 4 basic financial statements and financial statements more generally, 3 kind of key points worth keeping in mind. One is that some of the quantities on financial statements represent what's sometimes called a stock, and others represent what's called a flow. So stock quantities, and this is a different use of the word stock than when we talk about stock like stocks and bonds or equity. But stocks of a financial quantity mean the amount of something that exists at a particular point in time, how much inventory is on the shelves, how much cash is on the books. As distinct from that, flow quantities talk about what has happened over a period of time. So any kind of stock quantity or point quantity is always going to be as of a particular moment, whereas a flow quantity is going to cover what happens over a period of time. Typically, that's going to be either a fiscal quarter or a fiscal year, and it's important to know what period you're talking about. The second kind of key point to keep in mind is the distinction between profits and cash flows. And the difference between these things relate to what accountants often call accruals. In particular, profits, which is the difference between revenues and costs, are going to try to match the timing of revenue to when a sale, in a sense, happened, and costs to that same period of time. So sometimes a firm may actually pay cash for an expense before they make a sale, or they may not have to pay cash until after they make a sale. And similarly, a firm may make a sale on which they've already collected the cash. Maybe they sold a gift card or they had some kind of prepaid order, or they may not have to pay cash for an expense, say, until after the expense is incurred. So I'm working for Babson today. Babson is incurring an expense to pay my salary, but I don't actually get paid until the middle of next month. So that distinction is between what's called profits and what's called cash flows. And then the third thing, which is not something we're typically going to see so much on the financial statements, but it's something we really have to have in mind, is the distinction between something's cost and something's value. So things can be worth much more than a firm pays for them. They can, of course, be worth less than the firm pays for them. Most things, in particular on the balance sheet, are going to be recorded at cost, so at the amount of money that the firm paid for them. And that may represent a significant understatement or overstatement of the value of things. So we're going to ultimately build up towards having valuation models where we're going to try to estimate the value of firms or the values of parts of firms or businesses. And looking at the financial statements is going to be an important component of that valuation process. But just because an asset, say, is listed on the balance sheet as being, $1 million asset, that doesn't mean it's actually necessarily worth that same $1 million. So let's start by talking a little bit about the balance sheet. Okay, so the balance sheet is a point in time. It covers a stock as of a particular point in time, and typically that's going to be the last day of a fiscal period, so the last day of a fiscal year, a fiscal quarter. And the 3 key things that are on the balance sheet are information as of that date about the firm's assets. That's everything the firm owns that's valuable. And I'm going to put kind of an asterisk on that for now, and make a point about maybe things the firm owns that aren't necessarily going to be on the balance sheet. Liabilities, that's everything the firm owes. So it's money that it's borrowed explicitly by doing things like issuing financial debt, but it's also money the firm owes, say because they have employees who've already worked but haven't yet collected their paychecks. And then the third thing that's going to be on there is what's called shareholders' equity. And that's money that shareholders have invested in the company, that the firm's owners have invested. And that may be actual cash that they've, that equity holders or shareholders have like written a check to buy shares directly from the firm. But it may also be money that the firm earned on the shareholders' behalf, and the shareholders decided, hey, let's actually leave that money invested in the firm. We call that reinvestment in retained earnings. And so that gives owners an additional sort of stake in equity, not because they've actually sent that cash into the firm, but rather because the firm earned those profits or net income, and rather than paying them out to the shareholders, it stayed within the firm. So the asterisk on assets, in particular there, when I said everything of value that the firm owns, is that because things are recorded on the balance sheet typically at cost, that is to say what the firm actually paid for them, if the firm owns something or owns an asset, but it didn't pay money for it, if it didn't sort of write a check or pay cash, those assets may not be recorded on the balance sheet at all. And kind of the classic examples of those are things like brand equity. So, the name Coca-Cola is extremely valuable to Coca-Cola Incorporated. They've sort of built that brand over a really, really long period of time, and at great cost. They've done it through marketing activities, perhaps through product quality, just through the longevity of the company. But they didn't actually buy the brand, even if they invested in it. And because they didn't buy the name Coca-Cola, it's typically not going to be recorded as a financial asset on the balance sheet. So it's things that the firm owns, but in particular, it's things that the firm owns that they purchased and recorded at cost, or at some kind of maybe adjusted value of cost. Okay, the second key financial statement that I want to talk about is the income statement. So the income statement is going to cover flows. It's going to cover a period of time, typically a quarter or a year, rather than just what's going on as of a particular point in time. What we sometimes call the top line, because it appears at the very top of the income statement, is the amount of revenue, so the amount of sales that the firm has done over the period of time. And then at the bottom, we have the amount of profit that they've earned. That's often called the firm's bottom line. And the difference between those two is the expenses. So typically an income statement is going to start with revenue, then it's going to subtract out a whole bunch of different types of expenses, and then whatever's left over is going to be the firm's profit, also known as net income or earnings. Okay. Third key financial statement, or third and fourth, are the cash flow statement. So as I mentioned, that's going to cover over a period of time the cash that's received by the firm, cash inflows, and the cash spent by the firm, or cash outflows. And then finally, the statement of shareholders' equity. And typically a statement of shareholders' equity is going to describe what was going on at the beginning of the period, the end of the period, and the changes. So often this includes kind of a stock and a flow component, and provides a detailed account of the changes in various equity accounts, in particular common stock and preferred stock, retained earnings, which is part of the common stock account, and then the flows in and out of those accounts, or changes in owner's equity.